folks. Welcome back to the Tailored Tax Show, the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes legally and perennially. I'm Terrence Taylor. I'm the co-founder of Tailored Tax. I'm an enrolled agent, and I have my MBA from Harvard. This is my partner, Big Al Darnell Jr. Say what's up, Big Al.
What's going on, everybody? I'm Big Al, and I love my mama.
Yeah, Big Al's also an enrolled agent, also has his MBA. In this episode, we want to talk about what can you still do before April 15 to save big on taxes. So, Big Al, I'm going to kick off to you because this is one of the subjects that you love the most. What can folks do? Hit us with one or two things.
Well, I'll tell you this. A big thing that I'm not sure. Well, I think everybody knows about it, but you can still contribute to your retirement up until April 15th. Whether it's a traditional IRA, a Roth IRA, a 401k with your job, or a SIP IRA or simple IRA with your business, those contributions can still be made all the way up until April 15th. You have to make sure that you contact your the representative associated with that account to let them know that this contribution you're being made should be applied to the previous year. I literally just worked with a client where on their form, it showed that they contributed $14,000 to their IRA. They can't do that, but she said that she literally did it online and associated 7K with each year, but they mixed it up. So I gave her the verbiage to email and contact that company to get that resolved. So that's going on right now. So anyways, that could definitely save you, a decent amount on what you're making. How about you, Terrence?
Well, before you get off that topic, Big Al, you didn't mention our favorite one. What about that backdoor Roth?
Oh man, of course, the backdoor Roth. So in order to do the backdoor Roth, you got to put it in a traditional IRA first of all, anyway, and that's why I was stressing about making sure that conversation was had and it was documented that contribution is going to be for 2024, actually 2020 this year, current year, depending on when you're listening to this. So no, I appreciate that. And then once it's in the traditional IRA, then you roll it over to a Roth IRA, and hopefully you do it pretty quickly so that you can, so that there's no taxable income on what you had in there.
Cool. Did you already mention the HSA?
I did not. Could you?
So, folks, if you have a health savings account, so that comes into play when you have a plan with a high deductible, you can still put money in it because that's the triple threat, right? So the contribution is tax-free. And when you invest it, it can grow tax-free. And when you take out the money and use it for health-related expenses for you and or your family, it can grow tax-free. So it's a relatively small amount, but if you plan ahead and do this every year, it could build up, right? So think about that. All right, Big Al, the next thing we want to tell folks is, hey, you can still leverage business and investment deductions. So picture this, if you own a business and you've made some substantial investments, make sure that you're optimizing your deductions and deferrals before you file. So here are a few things to watch out for. Bonus depreciation and Section 179 expensing. So if you bought business assets, whether those were equipment, vehicles, etc., ensure you maximize write-offs instead of depreciating them over years. What about QBI, qualified business income deduction? If you're eligible, ensure that you're maximizing that 20% pass-through deduction by optimizing your taxable income. Third, and our favorite, Big Al, REP, real estate professional status. You want to tell us a little bit about that one?
Yeah. So with the real estate professional status, there are very, very clear and distinct qualifications on getting that. Some of those qualifications are you have to put over 750 hours in a year into real estate trade and activity, and being in mortgages doesn't count. Another thing, it has to provide a significant amount of income to your household, I forgot the third one, but the big thing that I want to impress upon you is that usually in order to get this designation, you have to do it the year before. So right
Mhm.
now, is a great time to do it. And I don't think you could use any extension. You have to file for this rep status by April 15th of this year in order for it to be an active designation for your 2025 returns come filing next year.
That's such a great point, Big Al. So for those who have already chosen this designation, please ensure you actually use it because it is one of the most powerful ways. If you're a W-2 earner, meaning an employee who has a lot in income, like many of our clients, this is a very powerful way for you to reduce your taxes. We have a couple of clients who are W-2s and they've made over 2 million and they've paid over 1 million in taxes. So it's really important to make sure that when you get and you qualify for things like real estate professional rep status, that you actually use it. And to Big Al's point, if you haven't already qualified, then now is your time to qualify. Big Al, we could also tell them a little bit about tax loss harvesting and strategic
Yeah,
asset sales. Can you cover that?
yeah, 100%. So here's the beautiful thing about tax loss harvesting, just to give you an idea, is that every investment that you ever invest in is going to have highs and lows, ups and downs, waxing and waning, so to say. And the key is that we all know from experience and education or whatnot, especially if you're a or a long-term investor, that the stock market usually goes up, even if it drops down just like it did in 2020 because of COVID. If you would have kept holding those blue chip stocks, especially not so many of the speculative ones, then it would have went right back up, exceeding what your returns were before 2020, just because you didn't go crazy and sell everything in 2020. So what happens is that tax loss harvesting means that where it dipped in 2020, what you do is you sell it in order to capture the loss. Now, mind you, I'm not trying to get too thick into the weeds, but
Uh-huh.
you're gonna have to wait about 30, 31 days so that you can avoid the wash sale rules of buying and selling the same stock. But you have to wait 31 days and then you can jump back into that stock and you've appropriately captured that loss. And then once you jump back into it, hopefully it hadn't fluctuated massively, then you can still ride the waves back up. Now, one thing that we do suggest is that there are a lot of mirroring stocks. So let's just say that I don't know, AutoZone and O'Reilly's. I'm not sure if they're even traded on a New York Stock Exchange, NASDAQ, or whatnot. But if you have a strong $50,000 position in AutoZone and you want to take advantage of tax loss harvesting, then you could take the $50,000 out when it's at $40,000, throw it into O'Reilly's because they're probably going to be following the same track. And then after 31 days, take it back up out of O'Reilly's and put it back in AutoZone, and you could continue that position. But you've actively captured that loss that wasn't a sustained loss, and you can ride that on to the bank, and you can use that to offset your gain. It's a beautiful situation if you know what you're doing, but you have to really be actively engaged in this, or you have to make sure that your financial advisor knows how to do it and has your permission and okay or your directions on making those types of moves.
Yeah, you actually raised a very valid point that we always stress, and that is obviously we're talking generically about the like a category of taxpayers, but for each individual taxpayer, folks, you got to consult with the experts that you already are working with or should be working with. So whether that's your financial advisor, whether that's your CPA who's helping you to file, and or tax strategist like us, you want to make sure that you're getting the best advice for your individual situation. Big Al, let's take this thing home. We want this to be short and sweet. It's tax season, so we're busy, right, helping lots of clients. Let's talk about the third strategy, which looks at what folks can do when they want to fund and optimize charitable giving. So
Yeah.
I'll kick it off and please, jump in, right? So folks, think about this. There's such a thing as being smart when it comes to your philanthropy. We've already done a few podcasts on strategic gift giving, right? Being smart about philanthropy philanthropy can lead to huge tax savings. So if you didn't maximize your donations already, you may still have options. And Big Al's going to kick us off with the very first one. What's their first option, Big Al?
Donor advised funds.
Yeah, all day.
Yeah. The beautiful thing about donor advised funds is that you as the donor gets to advise this company that runs the fund on how you want your money, or where you want your money contributed from, which charity you want your money contributed to and when. That's the operative word. Beautiful thing about a donor advised fund is that although you might donate 100 grand in 20, in whatever the current year is, because it's to this qualified donor advised fund, you get the $100,000 write-off, even if you haven't directed them and advised them on exactly where to send it. They can send it 2 years, 3 years, or however many years later. They know all the rules on the timing and what percentages have to be distributed, period. But you can have them send it at a later year, but get the immediate write-off. And why would you want them to send it at a later year? Here's why. Because you're trying to build this donor advised fund, or you want to build a situation where the growth from the fund actually powers more sustainable giving over a longer period of time. So if I put $100,000 in there and I say, hey, look, deploy that $100,000 towards this church or this, child, fund or whatnot, then that $100,000 doesn't have time to grow. But if you put $100,000 in and it's earning 8 to 10%, then guess what could be done? Then this church or this child hospital or whatever can get $8,000 to $10,000 every single year, almost in perpetuity. Of course, there's fees and so forth that comes out. But then next year, if you put another 100 grand, now it's 16,000. So that's the purpose of donor advised funds. That's a benefit that you can get, the immediate tax write-off, even though it's not an immediate deployment of those funds to a charity. How about you? What's the second?
Yeah. Second one, Big Al, is qualified charitable distributions, or QCDs. Picture this. You're over age 70 and a half, and you can direct your IRA distributions to charity tax-free up to $100,000. So we have a client that we're working with and looking at this because the client qualifies. They're over this age. And the beautiful thing is the charity gets that money. You get the satisfaction of helping, and you also get the pleasure of lowering your taxes legally up to 100K. Big outtake. Yeah, go ahead. Yeah.
Is that a lot of times at that age you have RMDs, which are required distributions. So once you built up and use all these strategies to build up this Roth IRA or SEP IRA or whatever type of IRA into something that could fund your situation, your life during retirement. But let's just say that you have other income coming in too, because you signed up for some fixed index annuity with Terrence, or you paid off an investment property and that investment income is coming in. Then what you could do is you could use these QCDs to offset your RMDs, turn those RMDs into QCDs up to 100 grand and avoid that extra tax.
That's brilliant, especially for those who are 73 and over. Fantastic. Now, tell us about the last part of this strategy.
Yeah, gifting appreciated assets. Beautiful thing about gifting appreciated assets is that, let's just say you bought into, let's use the same thing as a stock I mentioned earlier, $50,000 into AutoZone stock. So let's just say in 2020, I invested $50,000 into AutoZone stock because I said, hey, cars are still going to be here, even if the economy's down. I bought it at a very depressed rate in 2020. And now by the time I'm 65, or let's just say in 2040, this AutoZone stock is worth $250,000 because I bought it at a depressed rate, and over 25 years it's grown, et cetera, et cetera. Now, what I could do is if I have a windfall of a year, let's just say I sell some large asset or have a windfall of money come in, and let's just say that was $250,000, $1 million or whatnot. What you could do is you can donate that appreciated stock to a charity that accepts stock, of course. And we can also help you charities, for everybody that's running a charity that's in here. We can help you and show you how to set up your charity to receive donations of things other than cash. All right.
Mhm.
Donations of stock, donations of cars, artwork, et cetera, et cetera. There's a process that you can take to receive those donations, liquidate them, and use those funds for yourself. You don't want to restrict how people give to you. But anyways, so I could gift that my initial investment of 50 grand and get a $250,000 write-off 20 years later, because of this opportunity, this tax opportunity of gifting appreciated stock and getting the value of the stock at the time that you gifted it versus the value of the stock versus at the time of purchasing. But yeah, how about you, Grant? Anything else?
Hey, let's take it home and just do a quick synopsis. So, folks, we've shared with you 3 strategies that would help you to save a bunch on taxes before April 15, as long as you act before April 15, right? First, max out tax advantage accounts. 2, leverage deductions. 3, optimize charitable giving. All 3 combined could be massive for you. Each one could help you to save maybe that little extra that you need to reduce your tax bill or potentially make your tax bill 0. So if you like what you hear, let us know, drop us some comments, and feel free to reach out to us if you want some advice from a tax strategy point of view. So you can reach Big Al at BIGAL at Taylor Tax, TAYLORED or me, Terrence, at taylortax.ai, TERRENCE. And check out Tax Strategy GPT, our GPT that's on the OpenAI GPT store if you want to get some do-it-yourself advice and information that you can then confirm with your tax strategies. All right, folks. Thanks a lot. See you soon.
Cheers.